Hello, everybody, and welcome to the third International Conference on Business and Policy Studies. Let me start by introducing myself. My name is Dr. Fawaz Khaled. I'm Senior Lecturer in Real Estate Finance and Investment at the School of Built Environment in Oxford Brookes University. And I am one of the keynote speakers and member of the editorial committee in this conference. Following the title of this conference, my research is a policy-oriented topic focusing on mortgage default, property prices, and bank lending behavior. My presentation is going to be structured as follows. I will start with a background about my research, then motivation and import of this research, why I chose Hong Kong as the case study for this topic, the model specification, the data, then following with the results and analysis, and we'll finish the conclusion. As a background, the interaction between macroeconomic fundamentals, financial market, and real estate market has been always blamed for being the root of the financial crisis through accumulation of housing market bubbles that result in ultimate collapse of the financial and the real estate markets. Among other sources of banking instability, we have something called mortgage delinquency. What is the meaning of mortgage delinquency? Mortgage delinquency refers to the failure of borrowers to make their scheduled payments on time. In the context of the real estate market, a mortgage is a loan taken out by a person or entity to purchase a property. The borrowers of this mortgage is obliged to make regular monthly payments to the lender in order to repay the loan over a specific period, say, for example, 15 or 30 years. When a borrower falls behind on their mortgage payments and misses one or more payments, they are considered to be delinquent. A borrower who is delinquent on their mortgage may face various consequences, including late fees or negative impacts on their credit scores, on potential foreclosure or default. Why analyzing mortgage delinquency is a major concern for banking? Well, it's actually due to the high cost of managing mortgage delinquency and the associated burdens when selling out the property in case of foreclosure, which is usually evaluated around 5 to 10% less than its neighboring peers. The importance of analyzing determinants of mortgage delinquency is that it might be the first step toward foreclosure or defaults. Therefore, investigating these drivers helps to track risky loans at earlier stage and allow timely intervention before default becomes inevitable. In an attempt to dampen the bank's exposure to swings in the real estate prices, many macroprudential policies are designed to provide banks with sufficient caution to resist shock triggered by real estate market disturbances and counteract the repeated occurrence of financial and banking crises. So what are the motivations for this research? The motivations is that the nexus between real estate markets and the banking industry is justifiably the focus of much attention in the well-established literature, and it has been widely investigated in policy-oriented studies such as the International Monetary Fund and the Bank of International Settlement. However, the perspective that seems to grab much of the academic researchers' attention appears to be considered on one of the causality direction between the two markets using a single equation setup rather than dynamic model that is able to account for the interaction between the two. What does that mean? We can find lots of research about the relationship between the real estate market and the financial market, but they are either focused on the impact of the real estate market on the financial market or vice versa, the impact of the financial market on the real estate market. Then in this case, they analyzed just one direction of causality. If we keep the framework of these works confined to a single equation, this exposed them to the simultaneity problem and lack of focus on the magnitude of causality between the variables of interest. The purpose of this study is filling this gap by testing the existence of possible long-run dynamics and short-run effects between bank lending, residential property prices, and mortgage defaults in Hong Kong by using specific error correction model. Now, what is the importance of this analysis? What is the importance of analyzing the interaction between these two markets? If we find an evidence of co-integration between these two markets or indicators from these markets, a multifunctional toolkit of financial, monetary, and macroprudential means are required to govern the multidirectional effects and the interaction between the three cycles in order to maintain a balanced relationship between them, particularly when they interact with each other, and the interaction itself between these factors is always being claimed for being the originator of the financial crisis. The next point that I would like to highlight in this presentation is why I chose Hong Kong as a case study. The first reason is that Hong Kong is an externally oriented country, which means that it's a very open country, has a high volume of foreign direct investment, and the country itself has lots of international investments outside of Hong Kong. The second reason is that the real estate market occupies a fundamental position in Hong Kong economy, with the house being the most preferred source of investments for the majority of the population in Hong Kong. For example, in 1991, the residential mortgage lending was about 20% of the bank's lending portfolio, while in 2002, it reached to a peak of 37% in 2002. This means high concentration of mortgage loans in Hong Kong bank loan portfolio, and this provides a very important case study and motivation focusing on the residential mortgage loans delinquency rather than other kind of loans. The third reason is that for any country or for any financial market, there is always an arsenal of several financial and monetary tools used to fight against the buildup of the systematic risk in the financial institutions, such as the interest rate. The interest rate is a tool in the banking system in any country to fight against the credit risk. But in the case of Hong Kong, due to the currency board regime, according to which the Hong Kong dollar is pegged to the US dollar, is connected with the US dollar, interest rate as one of the most efficient monetary tools cannot be operated to safeguard the macroeconomic stability against swings in the property prices. Hong Kong is a pioneer developer and user of prudential tools attempting to safeguard the stability of the banking system. For example, Hong Kong Monetary Authority started imposing loan-to-value caps since 1991. Hence, to answer the question of how effective is the loan-to-value in reducing the bank's exposure to risk associated with property markets, boom and bust cycles, the impact of loan-to-value on the evolution of mortgage default is going to be considered in this work. So we are going to analyze the impact of loan-to-value as a macroprudential tool in reducing the credit risk. And the last reason is the behavior of the real estate market in Hong Kong, which is unique behavior. If you look at the history of the private property prices in Hong Kong over the past 2 decades, we can observe high volatility with several episodes of booms and busts associated with extraordinary swings in house prices. This is by stark contrast to other real estate markets where episodes of booms and busts were almost single episode of large price swings, ending up with the entire collapse of the house prices. In other words, the peculiarity of the Hong Kong real estate experience is that property prices fluctuations was as vigorous as in other countries, but with higher frequency of occurrence in Hong Kong. Now moving on to our model specification. When we do any analysis on long-term and short-run relationship, the first model that might come to our mind is the Johansen approach, VAR, which is the vector autoregressive model, and error correction model. But these two models have some limitations. First of all, if you are applying Johansen approach, the model is very sensitive to the size of your sample. And my sample size in this research is a bit limited for specific reasons that I'm going to cover later. And the second one is that the variables included in the estimation should be non-stationary, which means that they should be co-integrated of order 1. That means in the presence of variables that are stationary in level or co-integrated of order 0, using Johansen approach will deliver a biased estimators. Then we cannot use it if we have one of our variables stationary at level 0. To address this problem, the autoregressive distributed lag model could be used. And what is the autoregressive distributed lag? Is a model that used to investigate co-integration between set of variables. It can be applied whether the variables are entirely integrated of order 1 or entirely integrated of order 0 or fractionally integrated. So if we have variables that are integrated of order 1 or variables that are integrated of order 0 or a mix of 1 and 0 co-integration, then we can combine them in this module safely. Furthermore, in contrast to the Johansen approach that is severely sensitive to the sample size, the autoregressive distributed lag is less prone to the sample size distortion. Now, our data. Our data are a monthly time series data for Hong Kong, spanning over the period from June 1992 to June 2009. The limited data for this period is owing to, number one, the availability of data. Before 1992, we cannot find data for the mortgage delinquency in Hong Kong. And the other reason is that our intention to keep the analysis confined to a critical period of financial turbulence during the Asian financial crisis so that we can quantify the impact of the financial crisis on the evolution of credit risk and mortgage delinquency in this period. The indicators that I'm using in this research are D is the residential mortgage loans delinquency ratio. The data are obtained from the Hong Kong Monetary Authority and it's used as proxy for mortgage delinquency for credit risk. The other indicator is the house price index, HP. Property price index has been constructed by calculating a compound property prices index using different types of properties. The third indicator is L, which stands for bank lending behavior. The data that are used to proxy bank lending is the gross loans made in Hong Kong and the data obtained from the Hong Kong Monetary Authority. The last variable, which I talked about before, is the loan to value. The data for loan to value were collected from Bloomberg to capture the effectiveness of macroprudential tools in dampening the impacts of swings and fluctuations in the property prices on the stability of the banking system. Now we are going to discuss some stylized facts about our data. Here we have plot for bank lending and property prices, and the chart shows high correlation among the two series, which suggests long-term association and possible co-integration between them in the long run. Please note that the gross loans made are scaled on the left-hand side axis and property prices is scaled on the right-hand axis. In this chart, we are looking at the history of mortgage delinquency. Looking at this chart, it suggests a potential presence of structural break because as you can see from the chart, mortgage delinquency start to go up from the start of our time series from 1998 to reach to a peak point at 1.3 in 2000 and then it start to go down very quickly. The behavior of this time series suggests the presence of structural break in our time series caused by the Asian financial crisis, which is crucial to correctly specify the model and might undermine the reliability of our estimated parameters if not accounted for properly. So what does that mean? It means that we need to test for structural break in our time series, which brings me nicely to the next slide. So here I conducted test, which is the Piperon test, to determine the number of breakpoints, if there is any, in our time series for the mortgage delinquency. Clearly, the results highlight the existence of two structural breakpoints with the rejection of the null hypothesis of 0 and 1 breakpoints in favor of the alternative 1 and 2 breakpoints. What are the implications of this structure break? To account for the structure break in our data, we constructed a dummy variable, and we denoted in the module as DV, dummy variable, and we included this variable in the ARDL model to capture the impact of the Asian financial crisis on the evolution of mortgage delinquency. What is the dummy variable? The dummy variable takes the values of 1 during the financial crisis and 0 otherwise. And it's included as one of the aggressors in our model. Now, what is left before we can estimate our model is testing for stationarity or unit root test. All variables under consideration are tested for the existence of unit root, and the results reveal that, with exception of bank lending, which is integrated of order 0, mortgage delinquency, property prices, and loan to value are integrated of order 1. Therefore, the outcomes of the unit root test indicate a mix of I1 and I0, which is variables co-integrated of order 1 and variables co-integrated of order 0. In the light of these findings, we cannot use the Johansen approach, and we have to use the ARDL model, because the ARDL model is able to capture the data generating process in our series, which is a fair justification why we use the ARDL model. Then here we go, our estimated model. Firstly, just to explain what are the findings in this table. If you look at the first row in this table, FD, D/LTV, HP, and L. What does that mean? It means that in the first model, we estimated the mortgage delinquency as a function of loan to value, house prices, and bank lending. So our dependent variable is mortgage delinquency, and the independent variables are loan to value, house prices, and bank lending. And the same approach can be used to explain the following three models. Then, after we estimate this simple regression, we calculate F statistic for the model, and we use F statistic to make decision about the existence of co-integration. If you look at the note below this table, you can see a lower bounds and upper bounds critical values for each of these functions. How we make decision if there is co-integration or not? We look at the F statistic in this table, and we compare it with the lower bound and upper bound of the critical values. If F statistic is higher than the upper bound, then there is co-integration. If it is between the lower bound and the upper bound, the co-integration is inconclusive. If the F statistic is less than the lower bound, there is no co-integration. So if you look at this table, you can see that for mortgage delinquency, there is co-integration because F statistic is higher than the upper bound of the critical values. For the second model, which is the bank lending, there is co-integration, while for house prices and loan to value, there is no co-integration. To sum up, the overall results of the F statistic imply that causality is running not only from the bank lending towards mortgage default, but also on the other way around. Therefore, our finding confirms a unidirectional effect between mortgage default and bank lending behavior. Once we establish that the long-run co-integration relationship exists, the ARDL model is estimated. Overall, the results present in this table reveal that mortgage delinquency is highly influenced by loan-to-value caps, by bank lending behavior, and the fluctuations in property prices in the long run. If we take the regression coefficients one by one and try to analyze them, starting with the house prices. The coefficients of house prices is statistically significant with a negative sign, the coefficient of the property prices revealed that 1% increase in the property prices would approximately lead to 28% drop in the ratio of mortgage delinquency in the long run. That makes lots of sense given the dominant use of collateralized loans in Hong Kong. Hence, an increase in the collateral values contributes to the decline of credit default probability. The second variable, which is bank lending, is another factor that is found to influence mortgage delinquency evolution in the long run. The positive sign highlighting that 1% expansion in bank lending is expected to expose 35% of these loans to the risk of default in the long run. However, this exposure is highly influenced by the extent to which banks are involved in property-related activities such as mortgage loans and lending for construction and housing developments. But in the case of Hong Kong, banks' exposure to the real estate market is considerably high, given that around a quarter of the total loans issued in Hong Kong in 2007 were residential mortgages. What is more distinctive in this model is the impact of loan to value, which has the highest coefficient among other regulators, highlighting the essential importance of this tool in reducing the level of mortgage defaults, with the positive sign indicates that higher limits of loan to value expose higher proportion of mortgage loans to default. It implies an expected increase of around 47% in the mortgage delinquency would be associated with just 1% increase in the loan-to-value caps in the long run. Finally, the dominant variable that is included to identify the impact of the Asian financial crisis on the evolution of mortgage delinquency. It's highly significant, with the positive sign confirms the significant role that the Asian financial crisis played in driving up the ratio of mortgage delinquency in Hong Kong. Short-run dynamics in this configuration model. Mortgage delinquency here in this model shows some sort of persistence, with 2 out of 3 lags included in our model being significant, indicating the impacts of previous values of mortgage delinquency in the driving up of their current values, while the other variables such as property prices, bank lending, loan to value, they are highly significant in the short run and have the same signs as in the long run, which confirm our conclusions in the long run estimation. The last coefficient that we need to explore in this table is the error correction model, denoted as ECM T-1. Coefficient of the error correction model is highly significant and occurs in the negative direction. What are the implications or the indication of this coefficient? First of all, it confirms that the long-run relationship between the variables, and also it indicates that any disequilibrium occurs is corrected to converge back to the long-run equilibrium. However, the magnitude of the error correction term is to some extent small. It means slow adjustment process. That is, around 9% of the disequilibria of the previous month should adjust back to the long-run equilibrium in the current month, because we are using monthly data. ARDL model estimation of the mortgage delinquency has high adjusted R-square, revealing favorable goodness of fit of the model. Diagnostic tests were employed to check the validity of the ARDL estimation normalized on mortgage delinquency, and misspecification tests that are provided in this table show that the residuals have no serial correlation, they have correct functional form, and normal distributed residuals. However, homoskedasticity test is failed, which means that the residuals are heteroskedastic. But as demonstrated by several studies, detecting heteroskedasticity in residuals generated by an ARDL approach is not surprising, since the model combines variables integrated of different orders, and this does not undermine the validity of the estimation. So the model is still valid and robust despite the heteroscedastic residual. For the validity of this model, we have the following two charts, which are the stability test of the estimated coefficients. This suggests no evidence of instability in the coefficients, with these two charts or these two lines, the blue lines, lie within the critical bands of 5% confidence interval of parameters stability. This confirms global stability of both long-run and short-run coefficients in the error correction model. The conclusion. The article or this research investigates the long-run equilibrium relationship and short-run dynamics between mortgage default, property prices, and bank lending behavior in Hong Kong, taking into consideration the impacts of loan-to-value. We applied autoregressive distributed lag model to investigate the existence of co-integration on using monthly data. The overall findings of the ARDL estimation revealed that mortgage default is highly influenced by loan-to-value caps, bank lending behavior, and the variation or swings in property prices. However, loan-to-value revealed the highest influential determinant, highlighting the crucial importance of this tool in reducing the exposure of banking industry to housing market disturbances. These analyses provide evidence of co-integrating a relationship that govern the correction mechanism between these indicators in the long run to guarantee that any disequilibrium in the relation between these variables will converge back to the long-run equilibrium. Now, what are the policy implications of these findings? Well, the presence of co-integration relationship or to co-integrating relationship between mortgage delinquency, property prices, and bank lending has remarkable practical implication, as it implies a unidirectional effects between the three cycles. This means that the co-integration adds the need for a multifunctional toolkit, consists of financial, monetary, and macroprudential tools that are able to manage this interdependence and preserve a balanced relationship between these factors in a manner that contribute to the stability of both the banking system and the real estate market and ultimately to the entire economy. Practically also, although it's challenging, the findings suggest that planning the policies that governs these indicators in a wider policy framework through continuous cooperation between the policy makers in the real estate markets and the banking industry to achieve a sustainable and sound banking system. That concludes my presentation. Hope you find the presentation interesting. Best wishes from me. This is Fawaz Khalid. Thank you very much.